Imagine a skyscraper in Midtown Manhattan. It is a monolith of steel and glass, housing thousands of employees, humming with the energy of commerce. This is what the human mind defaults to when it hears the word corporation. We visualize physical presence. We visualize infrastructure. We visualize people. Now erase that image. Dissolve the steel. Remove the glass. Delete the employees. Replace that skyscraper with a single nondescript mailbox inside a beige office park in a tax-neutral jurisdiction. Inside that single mailbox, 20,000 separate companies coexist. They have no desks, no computers, and no staff. Yet through this metallic slit in the wall, billions of dollars in global capital flow every single year. This is the architectural paradox of modern finance. The most powerful entities in the global economy are not the ones with the largest footprints. They are the ones with the smallest. We are looking at the phenomenon of the shell company. To the uninitiated, a shell is a synonym for fraud, a tool for the illicit, but that is a pedestrian understanding. In the high-stakes environment of wealth preservation, a shell company is something far more sophisticated. It is a container. It is a shield. It is a portal. The paradox is that while these entities are legally solid, practically, they are ghosts. They possess the legal rights of a person. They can sue. They can be sued. They can hold property. Yet they have no pulse. They are the invisible atoms that make up the matter of the Billionaire's universe. We are about to strip away the branding and the marketing to look directly at the machinery. We will visualize the invisible lines of ownership that separate the wealthy from their wealth and, in doing so, protect it. This is not about evading the law. It is about using the law's own geometry to construct a fortress. To understand the mechanism, we must first define the object. Visualize a perfectly clear cubic box suspended in a void. This box represents the shell company. On the surface, it looks like any other business structure. It files papers, it pays a registration fee, it has a name. But look inside the box. In a traditional operating company, you would see gears turning, manufacturing, sales, labor. Inside the shell, the box is empty. There is no kinetic energy, only potential energy. The shell exists primarily to hold title to assets. It is a vessel designed to separate the beneficial owner, the human being, from the liabilities and the tax obligations of the asset itself. Consider the concept of the corporate veil. In legal terms, this is the barrier between the company and the individual. For the average business owner, this veil is a thin sheet of fabric. For the ultra-high net worth individual, the shell company turns that fabric into a lead-lined vault.
But the pulsing...
Why do we call it a shell? Because, like a hermit crab, it is a hard exterior housing a soft, vulnerable interior, the capital. The shell takes the hits. The shell takes the lawsuits. The shell navigates the tax codes. The capital inside remains untouched. The barrier to understanding this is the belief that a company must do something to be valid. In the eyes of the law, particularly in jurisdictions like Delaware, Nevada, or the British Virgin Islands, a company does not need to act, it only needs to be. This distinction is crucial. A shell does not produce income through labor. It produces efficiency through structure. It transforms high-tax active income into lower-tax passive income. It converts personal ownership, which is public and vulnerable, into corporate ownership, which is private and fortified. We are looking at a mechanism of detachment. The wealthy do not own assets. They control the entities that own the assets. This is the fundamental difference between being rich and being wealthy. The rich have their names on the deed. The wealthy have their names nowhere.
The exploded view reveals the intricate heart.
Let us disassemble this machine to see how the gears interlock. How does one construct an invisible empire? It begins with the jurisdiction. Visualize a map of the United States. Zoom in on the state of Delaware. It is small, unassuming, yet more than 60% of Fortune 500 companies are incorporated here. Why? Because of the Court of Chancery, a legal system that prioritizes corporate flexibility over rigid regulation. Step 1. The setup. The process begins not with a handshake, but with a registered agent. This is the face of the shell. The registered agent provides the physical address, that mailbox we visualized earlier. They receive the mail. They sign the receipt. When the paperwork is filed, the name on the document is not the billionaire's. It is the name of a nominee director or the registered agent. In many jurisdictions, the true beneficial owner is recorded in a private ledger, not a public database. This is the first layer of opacity. The link between the human and the entity is severed in the public eye. Step 2. The transformation. Once the shell is active, we witness the transformation of the asset. Let's say you possess a portfolio of high-growth stocks. If you hold them personally, you are exposed. Instead, you transfer these assets into the shell. Now the shell owns the stocks. You own the shell. This seems like a distinction without a difference, but it changes the physics of taxation and liability. This is where we encounter unrealized gains. Within the protective membrane of the shell, the value of these assets can grow indefinitely. As long as the shell does not sell the assets and distribute the cash to you personally, the tax event is delayed.
So far,
the shell acts as a capacitor, storing energy, storing wealth, without releasing the current that triggers the tax sensor. Furthermore, the shell can be structured as a pass-through entity or a C corporation, depending on the desired mathematical outcome. If structured correctly, expenses incurred by the shell to manage the investments can be deducted, further lowering the taxable baseline. Step 3. The output. The output of this machine is not a product, it is silence. It is the silence of the taxman and the silence of the litigator. By layering shells, nesting one inside another like Russian dolls, the complexity increases exponentially. Company A is owned by Company B, which is owned by a trust in South Dakota. If a creditor tries to pierce the veil of Company A, they find only Company B. They are navigating a hall of mirrors. This structure allows for capital gains tax deferral. When an asset inside the shell is sold, if that shell is part of a larger 1031 exchange structure or a similar deferral mechanism, the capital gains tax is not eliminated, but it is pushed into the future. And in the world of finance,
inflation
a tax
erodes
paid
the
tomorrow
value of your money
is cheaper
today,
than a tax
while
paid
compounding
today
interest
due
builds
to the
wealth
time
for
value
tomorrow.
of money. To truly grasp the magnitude of this advantage, we must place two scenarios side by side. We will observe the divergence in outcomes over a timeline of 20 years. On the left side of the screen, we have the standard investor. On the right, the strategist. Both purchased a piece of commercial real estate worth $10 million. The standard investor buys it in their own name. The deed is public record. Anyone with an internet connection can see they own it. Rent is collected, taxed at their personal income tax rate, which is the highest bracket. If a tenant slips and falls, the standard investor is personally sued. Their personal savings, their home, their car, all are on the table. Now, look to the right, the strategist. The strategist does not buy the building. A limited liability company, LLC,
The ownership of
Shell
the property
A,
is now
buys
officially
the
obscured
building.
by LLCA,
Shell A
making the
is
true
owned by a
beneficiary
holding
nearly
company,
impossible to trace.
Shell B, in Wyoming. Shell B is owned by an irrevocable trust. First, the liability. If a tenant slips, they sue Shell A. Shell A has no other assets. The lawsuit stops there. The strategist's personal wealth is firewalled behind 3 layers of legal concrete.
The red light
Second,
strikes
the
with
financing.
incredible force.
The
Yet the trust
strategist
vault remains
uses
completely
portfolio-backed
unharmed.
loans. Instead of taking income from the building to live on, which would be taxable, the strategist borrows money from the bank against the value of the assets inside the shell. Watch the flow of capital here. Debt is not income. Debt is tax-free. The strategist lives on the loan proceeds. Meanwhile, the rental income from the building remains inside the shell, used to pay down the loan interest and principal. The money circulates within the system, never crossing the threshold into the strategist's personal hands as taxable income. Third, the end game. 20 years pass. The property has appreciated significantly. The standard investor sells. They are hit with a massive capital gains tax bill immediately. The strategist does not sell the property. They keep it until death. At that point, the ownership of the shell, or the assets within, depending on the specific trust structure, passes to the heirs. Here we trigger the step up in basis. In many configurations, the value of the asset is stepped up to its current market value upon death. The millions of dollars in growth, the capital gains that accumulated over 20 years, are effectively wiped clean for tax purposes. The heirs receive the asset with a tax basis equal to its value on the day of death, not the day of purchase. The tax liability evaporates into the ether. The standard investor paid taxes every year and a final lump sum at the end. The strategist paid near zero, lived on tax-free debt, and passed the full value to the next generation. Same asset, different mechanism. Pull back the camera. Look at the entire grid. What we have visualized here is not a glitch in the system. It is the operating system itself. Shell companies, when stripped of their illicit associations, are simply tools of containment and flow control. They allow capital to move through the global economy with the least amount of friction being taxes, liability, and regulation. Is this fair? That is a question of morality. Is it legal? That is a question of fact. And the fact is, these structures are built on the bedrock of statutory law. They are the result of a legal code that incentivizes capital preservation. The wealthy treat the law not as a set of rules to be obeyed, but as a set of parameters to be optimized. The shell company is the physical manifestation of that optimization. It is the invisible box that holds the world's wealth. Understanding this mechanism is the first step in moving from a player in the game to a designer of the board. If you believe that dissecting these invisible mechanisms is essential for financial literacy, you know what to do. Click the subscribe button. Join us as we continue to decode the architecture of the 0.01%. This system relies on opacity. We are here to provide clarity. Consider this. Is the shell company a necessary tool for economic efficiency, or is it a dangerous veil that distorts market reality? Is it a shield for the prudent, or a mask for the deceitful? Leave your analysis in the comments below. I read the sharpest insights. Until the next investigation.